Turning our attention now to the economy, the RBA is well to meet tomorrow. Let's go to Managing Director of Market Economics, Stephen Koukoulas. Stephen, the RBA likely to cut rates, but the AFR, reading that this morning, many CEOs think that the RBA should keep its powder dry.
Oh, look, I think they should cut. I think the economy is weak enough. On Wednesday, we also get the GDP numbers, which are going to confirm GDP growth below 2% in annual terms. That's quite soft for an economy like Australia that's used to growing nearer 3%. So the RBA in cutting rates is going to be delivering a couple of things. First, for mortgage holders, it's a cash flow improvement on our levels of debt, so we're going to save a bit of money, assuming that it's passed on. For the business sector, which is still looking to gain momentum, they will have some interest rate relief, and the Aussie dollar should remain under 70 cents, giving our exporters a bit of a competitive boost.
But in relation to where they are at the moment, they're already at record lows, so they want to keep a bit of a buffer, don't they?
They do, but arguably that's what they were doing a year or two ago. They kept that buffer and now we use it. Now that we know that the economy has slowed and is slowing, housing is still weak, even notwithstanding some of this slightly better news on auction clearance rates. There's still some evidence that the housing is going to be weaker before it starts to improve. We know consumer spending's weak, and we know global economic conditions are cooling off. So I think this is... Now, they're using their powder, which they had kept dry. They're using it now. They're going to get rates down and try to just kickstart the economy into the end of 2019.
One of the arguments, though, is that given the coalition has won and there was a relief rally we saw on the stock market.
Yes.
Also in terms of, I guess, the property market, there's no capital gains tax changes, no negative gearing changes. So you would assume that should firm up the property market as well.
Yes, and Labor, by definition, in promising bigger budget surpluses, if you remember the statement they put out a week or so before the election, they had bigger budget surpluses in there from these tax policies that you mentioned. So they were going to have a slightly more restrictive stance on the budget. So we know the coalition's there. At least the first tranche of tax cuts will come through in coming weeks, backdated to the 1st of July. That's a little bit of money into the pockets of the economy. So again, I don't want to paint a picture where the economy is weak or in recession, but it just needs a little bit of a boost. I think that's what the RBA will be articulating when they announce the decision tomorrow.
And so that boost, we would see that flow through, you would think, to, as I said, the housing market. But more broadly, do you think it affects consumer and business sentiment?
I think for business sentiment, that's the other thing that tends to be overlooked. We always focus on housing. The business sector really matters. The business CapEx, capital expenditure numbers, which came out last week, were a little disappointing for the March quarter of this year, but they also had expectations for next financial year, and they're actually quite upbeat. Yep. That interest rate cut, when we see it tomorrow and when it's passed on, should give the business sector a boost. And I think that's the missing link at the moment in the economy. We know the consumer's under a bit of pressure from wages, but it'd be wonderful to see CapEx, business investment, starting to kick higher.
And so, more broadly though, when you look at the international environment, there are real uncertainties. They've been there for a while, but every day, every week we see Trump and China almost entrenching in their positions in this trade war. It's a worry, isn't it?
That's a worry. Global conditions will be the biggest thing that blow us up, if something does blow us up. So we've got to manage our own economy. That's why the Reserve Bank's tweaking rates, and that's why I presume the government's going to be implementing its tax cuts. If we are to go into recession, if we are to have a hard landing, it'll almost inevitably be because of a US-China trade problem. It could be a linkage to something in Brexit. The Euro Parliament was elected last week and there's sort of some disparate groups in there. Will that cause some of the sort of Italy and Greece to be shying away from the Eurozone, causing market ructions? More likely to be global conditions than domestic. So I think while we've got to manage the domestic economy, look globally to see whether there's big shocks coming.
When Australia looks internationally, obviously China, our biggest trading partner, how important is it that the government tries to keep that on an even keel?
Oh.
Particularly given the tensions with Washington. I mean, it's a difficult one, but how significant is it for us?
Hugely significant. A third of all of our exports go to China, and given that exports are roughly a quarter of our GDP, you can do some very simple maths, it's something close to 10% of GDP, a little under 10%, is Australia's exports to China. That's a big part of our economy.
So the projected surplus is basically written in China, essentially?
Yes. And the iron ore price, even though it's come off a little in the last week or so, it's still roughly $100 a tonne, so that's fantastic. But if that were to fall, maybe because the Brazilian mine reopens shortly, and the Chinese economy slowing down causes demand for iron ore to sort of weaken back, we'll run into not only an economic problem but a budget problem too, because I think that budget surplus that Mr Frydenberg was talking about for 2019-20 is very much premised on the iron ore price staying at an elevated level.
Stephen, as always, thanks so much.
Thank you.
See you soon. Appreciate it.